In July, Wall Street celebrated a Tesla deal that on the surface defies all logic. Tesla announced a massive $16.5 billion partnership for AI chips with Samsung. The market reacted instantly. Tesla's stock jumped over 4% on the news, Samsung's nearly 7%, a clear win. But Reuters' report revealed a stunning disconnect, stating the deal is unlikely to help Tesla sell more EVs or roll out robotaxis more quickly. So in the middle of a sales slump and a brutal price war, why would Wall Street celebrate a deal for chips that won't be ready for years? Because here's the real story. This deal isn't about fixing the old Tesla. It's the groundbreaking ceremony for a second Tesla. This isn't a lifeline for a struggling car company. It's the first concrete foundation for a vertically integrated AI hardware company. And the market reacted because it saw the first tangible evidence of a much larger narrative. That Tesla's car business is just a Trojan horse for its secret second act. To understand why, you have to deconstruct the deal itself. To understand why Tesla is spending billions on chips for the future, you first have to understand the crisis it's facing in the present. This isn't just a pivot, it's an escape plan. Because Tesla 1.0, the revolutionary electric car company, is under siege. Consider the facts. In Europe, a key market, Tesla's sales recently plunged a staggering 49%, even as the overall EV market continued to grow. Globally, the company just posted a 13% drop in first-quarter sales, its worst on record. The reason? A brutal, high-volume, low-margin war of attrition led by Chinese giant BYD. This unsustainable price war is crushing profitability across the entire industry. The damage isn't just theoretical, it's systemic. The sales slump is so significant that key suppliers like Panasonic have been forced to cut back their battery production plans. This is the new reality of the auto industry. And the Samsung deal is Tesla's declaration that it is building an exit ramp. The escape plan is built on a foundational belief, stated by Musk himself. For Tesla's grand ambitions in autonomy and robotics, off-the-shelf hardware is no longer good enough. As he put it on a recent investor call, there's still not a chip that exists that we would prefer to put in our car. This is the Apple playbook. To own the future, you must own the silicon. But here is the critical insight, straight from the deal's announcement. The new AI6 chip is explicitly designed not just for cars, but for Optimus humanoid robots and AI data centers. This isn't a defensive move to sell more cars. It's an offensive move to build a new kind of company, one where the car is just the beginning. By the way, deconstructing these kinds of strategic signals, connecting a single component like the AI6 chip to a company's entire future business model, is the core of our analysis in the ARPU newsletter. We'll leave a link in the description if you want to dive deeper. To understand this $16.5 billion deal, you have to see it as three stories unfolding at once. It's a story about raw buyer leverage, a story about geopolitics, and a masterclass in supply chain strategy. When you connect these three narratives, you see the full picture. The first story is about raw buyer leverage, and it starts with a supplier, Samsung. The company was vulnerable. In the high-stakes foundry business, they are a distant second, holding just 8% of the global revenue, utterly dwarfed by TSMC's 67%. Their brand new factory in Taylor, Texas, a multi-billion-dollar bet on their U.S. expansion, was a ghost town. Reports revealed the project was facing long delays because it had secured virtually no customers. This wasn't a deal between equals. For Samsung, this was a lifeline. For Tesla, it was a strategic move, securing a world-class manufacturing partner on incredibly favorable terms. But the brilliance of this deal isn't just who they chose, but where. This brings us to the second story, geopolitics.
By anchoring its AI-6 production in Taylor, Texas, Tesla is building a geopolitical fortress. This move is happening against the backdrop of the U.S. CHIPS and Science Act, which is pouring billions in government subsidies into domestic chipmaking. This deal allows Tesla to tap into that government-backed industrial strategy, creating a sanctions-proof, onshored supply chain for its most critical future technology. And finally, there's the third narrative, a masterclass in supply chain strategy. As industry reporting confirms, Tesla is executing a classic power play to build supply chain redundancy. They use Samsung for the AI-4 chip, pivoted to TSMC for the upcoming AI-5, and are now bringing the AI-6 contract back to Samsung. This is a deliberate strategy to ensure that no single company holds the keys to their entire AI roadmap. And the ultimate expression of this strategy is control. In a revealing post, Musk stated, "I will walk the line personally to accelerate the pace of progress." This level of customer involvement is almost unheard of. Tesla isn't just buying chips, they are co-opting an entire factory and embedding themselves in the manufacturing process. Leverage, geopolitics, and control. This isn't just a supply deal, it's the blueprint for a new industrial foundation.
This deal isn't just about securing a supply chain. It's about redefining the investment case for the company. It forces the market to answer a new question. What is Tesla now? The answer is that this deal marks the official start of Tesla's second act. It's the moment the company publicly graduates from an automaker that uses AI to an AI systems company that also happens to make cars. This was always the endgame. The WSJ report on the deal made it explicit, stating the move is central to Tesla's objective to restructure its business away from selling electric vehicles and into selling AI and robotics-based services. This shift in identity is precisely why the stock can rally even when car sales are down. Wall Street is reevaluating the company, not on the metrics of the auto industry, but on the metrics of big tech. The new peer group isn't Ford and GM, it's Apple, with its decade-long strategy of building custom silicon to control its ecosystem, and NVIDIA, with its fortress of integrated hardware and software. And just like those companies, the market is no longer valuing Tesla on its current earnings. That's why it trades at more than 100 times earnings, while legacy tech giants are under 40. Proof that it is being valued not as a manufacturer, but as a high-growth AI powerhouse. So the $16.5 billion partnership with Samsung is best seen as a down payment on this new foundation. It's a bet that the real value of Tesla isn't in the cars it sells today, but in the intelligence it will sell tomorrow. This brings us to the final and most critical part of the analysis. Who is paying for this pivot? The answer reveals Tesla's internal business model. The company is now operating less like a single corporation and more like an in-house venture capital fund. Tesla 1.0, the auto business, has become the cash cow. It's the mature, profitable division tasked with generating the capital. That capital is then being deployed to fund Tesla 2.0, a high-risk, high-reward internal startup focused on AI and robotics. And the numbers show just how dependent the moonshot is on the cash cow. The auto business still accounts for 3/4 of the company's total revenue. It is the sole financial engine underwriting this entire multi-billion-dollar pivot. But here is the strategic risk. A venture fund needs a steady stream of capital to see its bets through. And as Dan Levy of Barclays has pointed out, the weaker near-term business in auto sales directly takes away from the funding opportunity for these next-gen projects. With profits at risk from shifting regulations and a brutal price war, the funding for Tesla's internal startup is becoming less certain. This is the central tension for investors. It's a bet that the cash cow can stay healthy long enough for the moonshot to achieve commercial liftoff. And it's why the market's reaction to the Samsung deal now makes perfect sense. The celebration wasn't for a solution to the problems of the cash cow, it was for the first concrete sign that the moonshot's foundation is actually being built. The race for investors is no longer just about the car business, it's about the silicon brain that Tesla hopes will power its future.
So, that nagging question from the start, why did Wall Street celebrate a deal that doesn't fix Tesla's immediate problems, now has a clear answer. Wall Street is no longer watching the clock on the wall, it's watching the clock on the horizon. Tesla is effectively a company running on two divergent timelines. The first is the short-term clock of the auto industry. It's measured in quarterly delivery numbers, monthly sales reports, and the daily grind of a brutal price war. On this clock, with sales plunging 49% in Europe and its cash engine under pressure, Tesla is falling behind. But the Samsung deal is the first concrete, capitalized investment in the long-term clock. This clock is measured in years, in chip generations from AI4 to AI6, and in the multi-decade restructuring of the company into an AI powerhouse. The entire investment thesis for Tesla now hinges on a single, brutal question. Can the short-term clock keep ticking long enough for the long-term clock to pay off? The celebration you saw on Wall Street wasn't for today's battle. It was a bet that Tesla has finally secured the foundation to survive tomorrow's war. This also brings us to the critical second-order questions. How does Tesla's in-house silicon strategy change the calculus for companies like NVIDIA? And can the auto business truly survive long enough to fund this multi-decade ambition? These are the questions we dive into every week in our newsletter, ARPU. It's designed for anyone who wants to understand not just what's happening in tech, but why it's happening and what it means for the businesses behind the products. You can subscribe at the link in the description below. Thanks for watching.